Wednesday. It's Mario, owner of Sienna Mortgage here in Henderson, Nevada, and I wanted to give you a live stream today to talk a little bit about the beginning of 2025, how we started our year thus far, and what we've seen in the market as far as conditions and clients that we're helping, families that we're serving. What are we seeing in the market present day as of right now? So, I hope you guys are all having a phenomenal start to your year. We, of course, still inside of our first year as an official mortgage brokerage of our own. Being the owner of a mortgage company, guys, is absolutely insane. I cannot tell you how much fun it's been, how blessed I am to, again, be the owner of a mortgage brokerage. It's absolutely insane. Although I did grow up in the mortgage business and I grew up in a mortgage family and I worked for a mortgage company as my very first job, literally in and right out of high school. It's still surreal. I'm going on my 10th year as a licensed mortgage loan originator. And over the last 10 years, again, we've seen, almost a lot of successes, of course, but none greater than being the owner of my own mortgage brokerage. So thank you to each and every single one of you that have allowed me to do that. All of my amazing partners. Again, it's because of you guys that we're able to continue serving our community the way that we do and make these home ownership dreams a reality for people. That's one thing that I feel like a lot of people take for granted in the mortgage and real estate industry is what exactly we're dealing with, right? It's one of the things and reasons that I always talk about where, again, it's very much relationships over transactions for me. And when I run my business, when I partner with my industry partners, I'm working with people that treat their business the same, right? Relationships over transactions. Okay. And that's because of what we're dealing with, right? We're dealing with people's lives. We're dealing with people's futures. We're dealing with, in my case, people's financial security, their, their ability to empower themselves and their family, their financial future. So it's incredibly important to, I feel like, zoom out a little bit and treat it as such, right? Treat it as more of an opportunity for us in the industry to serve our community and to make those families, to enrich those families' lives through the power of homeownership. So I don't want to soapbox it too much, but I wanted to get into some details on how our year started thus far. As many of you know that, many of you guys that already work with me and partner with me, you know that one of my sayings and one of the things I believe in the most is transparency. Okay. It's a word that I've actually been using in the mortgage industry here now for the last several years. And when I first came back into the mortgage industry in 2016, I was using the word transparency, okay, coming from another sales industry that I'll talk a little bit about in a bit. But transparency was always super duper important to me, especially as a sales manager, sales trainer, someone that takes sales incredibly seriously. I feel like being transparent is one of the major keys to success. Okay. When I started using the word transparency in the mortgage space, when I came back, like I said, in 2016, 17, it wasn't greatly well received. A lot of people that have been in the industry a long time, some real estate partners, they didn't understand what exactly transparency meant. And for me, it's incredibly important. I'm super transparent with the business that we're doing, with the families that we're serving and helping, and with the way that I do business, right? One of the things that I do, and all of my real estate partners can attest to this, is I'm very giving with my time, right? So when I'm having these initial conversations with my clients or we're doing reviewing items together, I always like to do that either face to face, very old school style, face to face in person at my office or at a location of their choice, or on Zoom. Okay. I'm a big, big proponent of Zoom, using Zoom all the time. That's because on Zoom, I can screen share. And when we're screen sharing, we're able to dig in and drill down into very specific details of what our conversation is, going through that day. And it allows us to be transparent. Okay. I want to show you the ins and outs. I want to show you the details. I want to give you the keys to the kingdom. That way you are empowered as a consumer. Okay. So I love being super transparent with my clients and my business partners. I think it's super duper important. So as of right now in 2025, so far we are in the still beginning of March, almost the middle of March here, March 12th. We officially have 10 funded units, okay, and here at Sienna Mortgage, which me still being the only individual producer here thus far, we have 10 funded units. 6 of which have been purchase deals, and 4 of which have been refinances. We also currently have 3 deals in escrow currently, totaling a little over $1 million, which is 2 refinances and 1 purchase deal. So as of right now, and this is actually a lot different than it's been the last couple years, but we're finally starting to see the refinance business pick up again. Okay. So for the last couple years, again, guys, remember we've been in a high interest rate environment now since like the middle of 2022. Okay. Beginning of 2022 is when things pivoted, rates ticked up quite heavily, quite quickly, and there was nothing anyone can do about it. Okay. So we've been in this very high rate environment, or again, historically higher rate environment over this last couple years. Okay. Now, with that being said, has that stopped people from purchasing homes? Has that stopped us from still funding, 60 or so purchase deals year in, year out the last few years? No, it has not. What it's done though, it's made those that have been buying homes, okay, and that have been pursuing home ownership through this period of time, it's made them smarter, sharper, more educated consumers, hopefully, right? You're buying with a game plan. You're buying with specific strategies, right? Were we able to get temporary rate buy downs applied to your purchase? Are you in a temporary rate buy down for the next 1 year, 2 year, 3 year? Were we able to get a permanent rate buy down to put you in the most comfortable payment immediately? How exactly did we structure that person's purchase between the middle of 2022 and here in the beginning of 2025 to make them a homeowner, okay, and make them comfortable and in an affordable situation? So that's what we've been doing the last couple years. But again, now we're starting to see finally those refinances come back into the market, okay, because of how rates have trended down. Now, I'll talk a little bit about kind of where rates are right now, what we've seen over this last few months as far as trends, and then maybe projecting where they may be here as we push deeper into the year. But again, guys, just remember, please, please remember, nobody in our industry has a crystal ball. Okay. None of us, even the most Harvard educated, absolute wizards when it comes to finance, industry experts have a guaranteed idea or clue of where we're heading with the rate market. Okay. We all have projections. We all make educated guesses. We all use data to our advantage to be able to project, but nobody knows. So if someone's telling you they know where rates are going to be in the next 3 months, 6 months, 2 years, run fast. Okay. I promise you. Now, okay, we are currently in a spot right now, and actually in November, December this last year, right, we had a huge move down in rates. And when I say huge, I mean somewhere between like 0.5% to 3/4 of a point percent quickly drop in rates over that period of time in November, December. Okay, that means that in November, December, we saw FHA rates on the government side go from that 6.5% range to literally for some of our clients that were able to refinance at that time, sitting in somewhere like in the middle fives, high fives. Okay, so really, really beneficial. Now, conventional rates, same thing. They dropped about 0.5% or so, where like at the end of September, October, they were kind of in that 7%, 7.25, 7.5, even with some in some instances, to where they were kind of in that, 3/4 of a sixth, higher sixes range. So saving 0.5% very, very quickly. And again, market shifts, right? Not a different customer qualifying with a higher FICO score for any specific different reason. It's just the market shift, right? They happen quickly. Normally, when rates are going up, they'll happen dramatically, super duper fast, and it's tough to, right? That's why you want to make sure that if you like it, lock it, guys. If you're in a contract with a house, and hopefully as soon as you're getting into contract, you're reviewing financials with your mortgage expert, you're discussing rate locking at that time, and then again, if you like it, lock it. Be done with it, lock it. Be good for 30 days because market changes and market shifts will happen on the downside, meaning not good side, very quickly, right? We don't generally see rates come down nearly as quick. It'll generally take, 7, 10, 14 days to see some dramatic moves down in the rate market. And that's because, again, on our end in the mortgage world, we're tracking the 10-year bond market. Okay. We're tracking climate changes in the economic climate changes, and we're tracking the 10-year bond. Okay. So unless there is some, like with COVID, there's some absolutely global catastrophic pandemic type of situation, we're not going to see rates move down super duper fast. Okay. It's going to happen over time. But with all that being said, so November, December, we saw a nice push down in rates. And then, of course, unfortunately, in January and the beginning of February, rates push all the way back up, right? We basically lost all the gains that we had, and we actually, increased even a little bit. Now, just recently, at the end of February and beginning of March, we saw rates start pushing down again. Okay. We actually got below the 4.2 treasury bond, 10-year treasury bond, which is a big move, which again brought rates down by another almost 0.5% across the board. Conventional FHA, VA, USDA, etc. Okay. Now, again, timing the market, big, topic with a lot of our clients and investors and, potential home buyers that continue to sit on the sidelines and continue to try to time the market. I am not a fan at all. Obviously, just using the real world examples and past histories just within the last few months that I just told you, it is very, very difficult, okay, to time the market. First of all, to even be able to do that, you would have had to have already put yourself in a position to buy or refinance at that time. You would have had to have it official pre-approval ready to go, shopping for the house, offer accepted, and just happen to not be floating a rate at that time when rates push down and then you lock. Okay. So, very unlikely that's going to happen. Now, as we are getting deeper into a better rate environment, I've encouraged, and I always encourage all of my clients, obviously, to make sure that they're prepared. Okay. This is very, very important and something that I feel like I'm one of the best in the industry, definitely in the area with, and that is preparation with our clients. Okay. Meaning, when I talk to you, when I get an introduction, when I get a referral, when I have a client of mine that is put in a group text with me, the very first thing that I want to do with that client is schedule our first conversation as soon as possible. Okay. I'm going to schedule our first conversation and I'm going to send them an email with a list of items that we want them to put together, gather, and have ready for that first conversation. Okay. One of the reasons I want to do that is because I want to see at what stage is this person beginning their home ownership, home buying journey at? Okay. Are we in the very, very beginning stages where we're not even close to being able to start to try yet? Or is this person already ready to go? Okay. So, kind of checking the temperature of where that client is and then being able to address, right? What is their expectation as far as timeline? What is their current living situation? When do they need to move? That way, we can continue to help them develop this path moving forward. Again, also wanting to make sure that addressing, we're understanding the market, we're explaining historical evidence, we're telling them what our current clients are experiencing. Because, guys, another incredibly important thing that I've been sharing with all of my real estate partners and my clients alike is that because this market is so active, it's so different. It's changed so dramatically over this last few years. And I'm talking about not just the market itself with inventory and prices and customer, sellers' expectations, things like that. But I'm talking about literally from the mortgage guideline stance of things. Okay. Your FHA conventional VA guidelines have all updated, all changed, all become different, a little bit tighter here, a little bit looser there, a little bit, right? Just everything is different. So again, with the who you partner with matters moniker being part of Now My Flesh and Blood, okay, that is because the person that you're partnering with needs to be active in the market. Okay. They need to be doing deals. They need to be serving their community. They need to be up to date and educated and familiar with all of the things that have changed and evolved. Okay. That's how you get set up for success. So make sure that you're interviewing the right people when you're talking to them. Make sure that you are identifying not just who they are and what they do in your community, but what is their, track record look like? How many families have they helped over this last 6 months, 12 months? How many families took more than 30 days to get into closing? How many, ask some specific questions and interview the partner that you're looking to work with or that you're, chatting with, because it's very, very important, guys. Who you partner with matters. Okay, so we are in again a very dynamic, changing market. So clearly keep that in mind. That's going to continue throughout 2025 for sure. We're seeing, a little bit less inventory here, a little bit more inventory there. Obviously, right now, the price point that is the most difficult for people to navigate is still that like $250,000 to $400,000 price range. And that's because the vast majority of first time homebuyers and young homebuyers, that's where the affordability piece lands for them. Okay. Especially in a single income household right now, where, if you're making, I don't know, 7 to 8,000 bucks a month, which would be, a substantial single income for, a regular qualifier. It's tough. It's tough with normal, debts between car payments, student loan payments, credit card debt that rolls over month to month. It's tough to qualify as an individual qualifier. Okay. So that's why these $250,000 to $400,000 price points are so popular, and you see so much activity on these homes that when you're looking in this particular price range, you need to be doing so with all of your T's crossed and I's dotted. You need to have an official pre-approval letter that's already been vetted by a local mortgage expert. Your income, your employment, your assets, your credit has all been analyzed, items collected and ready to go, because those sellers, they're normally going through at least a few submitted offers to select who they want to work with. Okay. So that's very important. Now, not to say that your offer doesn't have a good likelihood of getting accepted with enough strength. It does not mean that you will not be able to negotiate closing costs, because 9 out of 10 of our buyers are able to negotiate closing costs. Doesn't mean that you're not going to be able to get favorable terms as far as due diligence periods, because you will be, right? Something that we really haven't seen much pushback on, or negotiations fall to the seller's advantage. It's just being prepared. Again, make sure that you're prepared. Make sure that you're working with an expert. Okay, somebody that is a subject matter expert in the field that you're partnering with them. On the real estate side, you need a realtor that does business, does active business right now, has a track record and history of successful business. What did they do? How did they do it? What was the experience? Boom, boom, boom. Okay. Your mortgage partner, same thing. Do your homework, do your research, make sure they're an expert in your community, and make sure they're able to communicate the way that you want to be communicated with. Okay. Super duper important. But yeah, that $250,000 to $400,000 price range is tough. So be prepared, be ready for that. As you start pushing up higher into that 450, 500, 600 is really when you start seeing a lot more, room start to open up, a lot more negotiating power, a lot more buyer leverage. So that 550 plus, 600K plus is really, really sweet. Love that. What else? So I have been seeing a lot of credit, I don't want to say issues, but credit being an issue for a lot of first-time home buyers, or, young qualifiers. Okay. There's a few different reasons for that. The first and most important reason for that right now is because America in general, okay, is drowning in credit card debt. Okay. Do your research, take a look at, whatever major publication you want to read about credit card debt, high credit utilization, just America in general drowning currently in revolving consumer debt. Okay. It's crazy. I think the average American right now has somewhere between 20 and $30,000 in credit card debt and car payments, and just incredible interest rates across the board on all of these things, auto loans, credit cards, just crazy. Okay. And with that alone, okay, we're seeing a lot of people, kind of the credit pinch, right? A lot of people not being able to afford what they should be able to afford, and a lot of times not able to qualify what they should be able to qualify for. So, keep a close eye on your credit, guys. I cannot stress the importance of having a strong credit profile, and having a strong FICO score really empowers you, okay, as a home buyer, as a homeowner. It doesn't disqualify you when you have a low credit score, okay? Because remember, guys, with FHA, you can qualify down to a 580 FICO score with only 3.5% down. And whoever keeps telling people that FHA is a first time homebuyer program, please stop doing that. FHA is not a first time homebuyer program, although it's very advantageous for first time home buyers. FHA is not only for first time homebuyers. FHA is a government insured mortgage program that is for a primary residence, okay? Where you're occupying that residence as your primary home, that's what an FHA purchase is, okay? You'll be able to qualify with down to a 580 FICO score with as little as 3.5% down. But if you're buying a $400,000 house, is $14,000 in down payment, right? Your down payment amount is always based on the purchase price of the home, okay? That's FHA. Now, on the conventional side with Fannie Mae and Freddie Mac, they're generally going to require and you're going to want to have a higher qualifying FICO score unless you're under what's called the area median income level. So for Clark County, we have a specific area median income level. If you're at 80% or below that area median income level, credit FICO score is less important, okay? But if you are a first-time home buyer, a true first-time home buyer, which is defined as somebody that has not owned a home in the last 36 months, you have not owned real property in the last 36 months, you are characterized and defined as a first-time home buyer. Now, first-time home buyer programs on the conventional side of things with Fannie Mae and Freddie Mac will allow you to only put down 3%. Okay. So a huge win for first-time home buyers on conventional. Okay. 3% down again on a $400,000 house is $12,000. So even less than FHA, which is great. But again, you're going to need to be a true first time home buyer that has not owned property in the last 36 months. On some of those programs, you're going to have to make less than the area median income level at 80% or below, or again, just be a first time home buyer. So a lot of programs, right, that will offer flexibility, but just remember or make sure you're targeting the right programs. Okay. Now back to the credit piece. So FICO score definitely important. Try to make sure at a minimum you're at that 580 threshold or higher. The stronger the FICO score, the more optionality that you'll have. Okay. Very, very important. But it's the items inside of the credit. So, what consumer debt, what liabilities is reporting your name? Okay. When we're talking about debt to income ratio, okay, this is something that a lot of people get confused with a lot. Okay. What are we looking at? So, we're looking at the first thing is your housing payment. Okay. That is what's called your front end uh, ratio. Your front end debt to income ratio is your house payment. So, your principal, interest, taxes, insurance, and HOA. That is what factors, that total amount is what factors into your front end debt ratio. Okay. So there's a specific ratios for both or for all FHA, VA, conventional, et cetera, that we need to meet for these ratios. Housing payment is the front ratio. Now, the back ratio is that house payment, all of those things, principal, interest, taxes, insurance, PMI, HOA, et cetera, plus all of the minimum payments, the minimum monthly payments that report to your consumer debt. Okay. So, again, very important to understand. We don't necessarily care about the total balances in someone's name unless they're student loan debt, which I'll circle back to here in just a second. We don't necessarily care about the total monthly balance debt. What we care about is the minimum monthly payments. Okay. So sometimes again, I help people that have 30, 40, $50,000 in credit card debt, but the minimum monthly payment across all of those is, four or $500. All we care about and all we'll factor in is that $400 or $500 a month minimum payment. Okay. So what we're looking at is minimum payment. However, with student loan debt, okay? And then this is specific if you have federal student loan debt that has not reported over the last few years due to COVID. Many of our clients have had deferred student loan debt, okay? How it is seen with FHA and Freddie Mac if you have deferred student loan debt, okay? That's fine. Clearly, you want it to stay deferred as long as possible, if I would imagine, right? But we're going to have to factor in the total balance. Okay. So if you owe $100,000, we're going to have to take a 0.5% of that total balance as your minimum monthly payment. Okay. So on FHA and Freddie Mac, it's only 0.5% of the total balance as part of your minimum monthly payment. Now on Fannie Mae, it's actually 1% of the total balance. So it's double the cost and way worse. So clearly, if you have deferred student loan debt, we would want to focus on an FHA or a Freddie Mac loan. Okay. So again, this is the expertise part, kind of moving all the cogwheels together at the same time to have these conversations with people, exactly qualify them for what their scenario and situation is, and make sure that we're suggesting and recommending the right program for that person. Okay. Now, very important because again, these student loan payments, they have not been reporting over the last 2, 3 years. And a lot of I've actually had a couple clients of mine that were in pre-approval stage. One of actually that was in escrow that had a couple of their student loan payments that had been deferred, hadn't even been reporting to their credit all of a sudden appear, all of a sudden start reporting late payments, and boom, that person's credit had dropped 60 or 70 points. So please make sure if you have federal student loan debt, you are keeping a very close eye on your credit. If you have deferred payments, please make sure that you put an auto pay on that account. So when they do become due, they are paid at least a minimum monthly payment. I try to tell every single person that I come across, and this is annoying to my wife because she hates when I'm talking about work all the time or talking about credit or talking about finance because I'm obsessed with it and I do, and that's what I'm passionate about. And that's always what I'm talking about in person and stuff like that. Don't worry, guys. I am kind of fun still, I think, but I'm not sure. But I'm always telling and preaching to everyone, please make sure at a very minimum that you're always making your minimum monthly payment on every single thing that you own: car payments, student loans, credit cards, personal loans, obviously your mortgage payment, your rent, right? Things that can report to your credit, right? Those late payments. I don't know where this narrative came from. I don't know. Maybe it was like 10 years ago I started hearing this where don't make your payment, late payments or whatever, collections, all that stuff will fall off your credit after 7 years. Guys, if that narrative is something that you have in your head and you think that making a late payment is no big deal, or having late payments report to your credit is no big deal, or when that item goes into collections, you're just going to be able to negotiate it down, guys, I cannot tell you the seriousness and how that will negatively impact your credit for literally probably longer than the next 7 years. Okay. Because one of the things, not only does it affect it dramatically immediately, obviously. So if you're looking to do anything financial in the next months, years, whatever, having late payments on your credit is going to dramatically decrease your qualifying FICO score. Having collections and charge offs of your credit, although I understand sometimes it's unavoidable, it's happened to me in the past. I've had to make, whatever, but do everything in your power to not let that happen because those collections, those charge offs, those things, right? They're nearly impossible to get removed off your credit. There's a whole process that you have to do to verify the debt, get them deleted from your report, which is very, very uncommon, so on and so forth. Which, of course, we also work with industry credit, credit repair experts that we can refer you to if, in fact, that's the case for you. But I'm trying to tell you, before it happens, please try to avoid it. Your credit is your harpoon, it's your tool. In the world of finance and money and all the things nice that we want to have in life, your credit score is the most important thing when it comes to your ability to borrow. Okay. It's going to give you the best terms possible. It's going to stop you from paying high interest rates. It's going to allow you to borrow money when you need to borrow money. Now, just remember, borrowing money doesn't mean to go out and willy-nilly spend money, but borrowing money allows you to leverage, you know what I mean, to enhance your life through buying real estate, through becoming a homeowner, through starting a business, through the things that will flourish in your life. Okay, so just please, if you guys want to talk about credit a little bit more together offline, I'm more than happy to always talk about credit. Obviously, I'm not a credit repair person myself. I'm a licensed mortgage loan originator as well as mortgage broker owner, but I'm just personally interested in credit. So I'd love to talk to you about that. Yeah, what else? So credit is a big deal, guys. Do not take it lightly. Work on your credit. For those of you that actually don't know, I bring this up on first-time homebuyer pre-approval Zooms, calls, meetings that we have all the time. Where super duper easy. I actually use it myself. If you guys have an Experian.com account, go on Experian.com, link your Experian Boost account, okay, to a card or bank account where you make your minimum monthly payments for your gas bill, power bill, light bill, sewer, trash, whatever. Obviously, make sure you're only linking it to an account that has always made payments on time, clearly. And that will pull those accounts and add them to your credit report as what's called a self-reported utility. So you'll get 10, 15, 20 points added to your credit for nothing. You're doing the work already, you're making those payments already. And when you're qualifying for a mortgage on our end for self-reported utilities, we immediately remove those from your debt to income ratio. We do not count self-reported utilities in someone's debt to income ratio. So big pro tip, add it. 10, 15, 20 points is a big deal for doing nothing You're welcome. Experian.com, Experian Boost. All right. Let's talk just briefly about a couple different strategies that our buyers continue to dominate the market with and how we're still, even over this last couple years where we've been in a higher rate environment, how these families that we've been helping have been purchasing their homes with as affordable of a payment as possible. Okay, guys. And that is through rate buy downs. Okay. First of all, this is the part that people don't talk about as much, okay? I'm gonna give you guys a little peek behind the curtain here. And one of the reasons I wanted to open my own brokerage is to make sure, okay, that I am offering the absolute best, most affordable options to my clients at all times, okay? I always like to educate my clients and my consumers on what are the costs and fees and differences with mortgage interest rates and closing costs and all that stuff across different places, depositories, online lenders, mortgage brokers. How do we get paid? What are rate, what are rates come from? What is a rate buy down? So on and so forth. So affordability is always going to start with the person that you're working with, the mortgage company that you're working with. Okay. It's a mortgage broker like myself, right? I do not have a football stadium, right, that I pay for, that I need to meet and recoup my funds from through the mortgage loans that I'm issuing to pay for the football stadium that I sponsor, or the billboards that I have, or the TV commercials that I'm advertising to, or advertising in general. Okay. If somebody is advertising to you, that's a cost that they have to recoup through your business. Okay. So make sure that when you're working with someone, being referred to someone, partnering with someone, you ask them and you vet them out as far as their costs, their fees, what rates are they being quoted? Okay. Because the rate buy downs and things like that are in addition to what are already the rates are being offered by that mortgage lender. Okay. So, me as a mortgage broker, my interest rates, the rates that you'd be offered with my company can be dramatically different than at another brokerage or a depository or an online lender. So, that's the starting point, guys. Again, remember who you partner with matters. So, you need to make sure that you're partnering with and working with not just the most knowledgeable, not just the most expertise in the field, not the one that just has, the highest chance of success in getting you to the finish line, right? That those are all obviously incredibly important things and, could be argued that they're the most important things. But at the same time, I also argue because we're in a financial services field and because that mortgage is tied to your next 10, 15, 30 years of, what you're going to be paying, I do feel like affordability and the cost to borrow is very, very important. Okay. So make sure you're vetting out the right partner and the right price. Okay. With that being said, right? So every lender is going to have different pricing to start with. And then in addition to that, right, you have these different tactics and strategies that we can use, okay? All of which currently we've recommended as seller paid, okay? So you're getting seller paid closing costs to pay for either a permanent rate buy down or a temporary rate buy down. Okay. First, let me just explain briefly in case you are unaware. A permanent rate buy down, okay, is a buy down that will permanently buy down your note rate. Okay. Note rate is the interest rate that you're closing on, your fixed rate for the next 30 years. Okay. So if you're locking a 6.5% interest rate, okay, that would be your 30-year fixed rate for the next 30 years, or unless you refinanced. Okay. That's a permanent rate, right? You can buy down that rate permanently, okay, at the time of rate lock for a specified dollar amount, okay, that will be based on the loan amount of the loan. That will bring the rate down accordingly based on the amount of prepaid interest you're paying. Okay. So sometimes quite valuable. Anything costing less than 1% of the loan amount, generally there is some argument and conversation that there is a lot of benefit to it, because anywhere between that, what we call par rate, where there is no cost or rate buy down, to somewhere around the 1% fee, you can generally buy the rate down somewhere between quarter to half a point for what would be 1% of the loan amount or less. Okay. So can be very beneficial. You have to do the cost benefit analysis. We have to see what that break even point is, but it could very well make sense for you. Now, what I like to pursue, especially in this rate market that we're in right now, which is a little bit higher rate environment, we already know, we already have evidence. I already have clients refinancing to bring their rate down to the lower rate. But I would suggest pursuing a temporary rate buy down to see more of a dramatic impact to your immediate savings right away, which is also paid for by the seller. Okay. So, just briefly, real quick, a temporary rate buy down can generally be done for 3 years, 2 years, or 1 year. Okay. The most affordable and easiest to negotiate is the 1 year temporary rate buy down, where if you started at a 6.5% interest rate for the full first year, your payment would reflect a 5.5% interest rate. Okay. Which will generally save you a couple $100 a month for the first 12 months. And then in month 13 and beyond, your rate and payment goes back to its original rate and payment. Okay. You can also do the same thing for 2 years. Okay. A 2-1 buy down can either be structured as 2 percentage point decrease in the first year, 1% decrease in the second year, and then back to the original rate in the 30 month 25 and beyond, the third year. Or you can do it for the same 1 year decrease 2 years in a row. A couple different ways you can do it, but you can do them for 2 years, also seller paid. Okay. Now, the hardest to get, the hardest to achieve, and what you normally will see from like a builder, somebody that controls the entire financing and construction and title company, and they have all the money in the world to give you as a purchaser of a new build property, is a 3-2-1 buy down, right? Which is what a lot of people are seeing advertised when they're like, we have 3% interest rates, but it's actually a 6% rate that's being bought down 3% for the first year, 2% for the second year, 1% for the third year, and then it goes back to the 6% rate. Now, here's my argument and conversation for like which of these programs is the most beneficial. First of all, they become available through negotiation. So a lot of times it's going to be up to the seller how much in closing costs we can negotiate from the seller to put you into one of those programs. Okay. So if we can only negotiate X amount of dollars and that's all we have available, then these are the programs that we have to use that money for, obviously. Now, I think the 1 year buy down to me is not just the easiest to negotiate, but it's the, simplest to navigate as far as for the first year, let's get you in the most affordable payment possible. We'll save you 200-300 bucks on the payment, right? The seller's only going to have to pay, let's call it 3,500 bucks to be able to give you that decrease in payment. And then we already know with where rates are trending, okay, the opportunity to refinance will be coming in year 2, 3, beyond. Okay. But for now, for the first year, let's try to get you the most affordable payment possible. Understanding in month 13 and beyond, we're going to get back to the original rate. So you and I together, I will be tracking actively where rates are over the next 6 months, 12 months, 18 months beyond, not just your equity on your property, but where rates are to be able to get you a refinance. Okay. So, super powerful tool. Want to be going through these exercises with your mortgage partner. You want to make sure that you have every tool available to you. Okay. As a first time home buyer, young home buyer, relocator, someone, that's just unfamiliar with the processes, which is most people, like 95% of people, right? You need to have all of these options made available to you, explained to you, educated on, and then not just that, but with a game plan and strategy moving forward after. Okay. Super duper important. But those are some strategies that we've been deploying. We've seen a ton of successes with. Like I said, 1-0 buy downs, temporary buy downs are quite common, to be perfectly honest with you, because you do not need to negotiate a large amount of seller concessions to make it happen. In addition to that, the difference in, if someone was to negotiate like $5,000 less in purchase price versus getting a 1 year rate buy down is the difference of, hundreds of dollars a month, some of the time. So there's a lot of advantage to strategizing the right way. It's going to take the right mortgage partner and it's going to take the right realtor partner to make sure that they're negotiating on your behalf and setting you up for success. So, super duper important, guys. Again, remember, I'm going to keep saying it. Who you partner with matters. Matters, 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 guys. Very, very much. Just remember Mario with Sienna Mortgage here, owner, mortgage loan originator, husband, My wife is now an officially licensed NMLS, has an NMLS number, passed her test. Of course, she passed it on the first time with like an 85% or higher, just crushed it, dominated it. So we are truly your local mortgage experts and husband and wife team. Hope you guys have a phenomenal rest of your Wednesday, phenomenal rest of your week. We're still in the first quarter of 2025, guys. There's a ton of room for you to get out there and dominate, for you to win. Make sure that you're working with the right partners because, again, remember,